Welcome back to Investing Talk Podcast. Today we're peeling back the layers on healthcare giant UnitedHealth Group. Is it, a fortress of stability in this volatile market, or maybe a titan grappling with some unseen cracks? We've sifted through a stack of recent market analyses, financial reports, and news articles you've shared to try and uncover the real story behind the headlines. We want to help you determine its true investment pulse. And before we jump into the details, if you find our analysis helpful, please remember to subscribe, like, and leave a comment. We really do love hearing from you. And hey, if there's a specific company you'd like us to look into next time, just drop it in the comments below. Okay, let's get into it. Let's begin with a look at UnitedHealth Group's recent journey. The last quarter, well, it's been anything but quiet. Back in September 2025, there was that market shakeup that really grabbed attention. A huge conglomerate, widely rumored to be Warren Buffett's Berkshire Hathaway, reportedly took a massive position, like $1.6 billion. That kind of institutional vote of confidence, well, it usually sends a pretty clear message, doesn't it?
Oh, absolutely, it does. And what's particularly fascinating here is just the immediate ripple effect. That news sparked a really sharp rally, pushing UnitedHealth's share price up over 20%. It visibly fueled optimism across the board. And then following that, we saw multiple prominent banks, think Morgan Stanley, JP Morgan, issue overweight or outperform ratings in August. So this kind of analyst conviction, especially after a period of recovery, it strongly reinforces that institutional belief.
You're right. The market certainly reacted.
And big
time. But despite that significant institutional boost, our sources also highlighted these persistent investor anxieties. We're talking about, elevated medical cost inflation and margin compression. A lot of that seems to stem from an earlier, $6.5 billion in unanticipated 2025 expenses. How do we square this market optimism with these really deep-seated operational concerns? Which factor, in your view, maybe holds more weight in the short term?
That's really the core tension right now, isn't it? It just underscores the inherent complexities of the healthcare sector, where market enthusiasm can collide head-on with operational realities. The institutional investment, sure, it provides a psychological lift, signals long-term value perhaps, but the operational realities of rising costs, those are immediate and tangible. One article we looked at noted this divergence really reveals a critical balancing act for UnitedHealth. In a high-demand healthcare market, top-line growth can easily, obscure underlying cost pressures. The real story here isn't just about growth, it's about the profitability of that growth, and that's currently being, let's say, severely tested.
So it's kind of a battle between perception and actual operational performance. Okay. Beyond the financials, our sources also point to some specific challenges. Looking back at August, UnitedHealth's Medicare Advantage business, had to publicly defend itself against ongoing regulatory scrutiny. One report described it as a full court press by regulators. That sounds pretty intense. How do those kinds of public defenses impact investor confidence, even if the company is citing strong integrity?
It definitely adds a layer of uncertainty, no question. Regulatory scrutiny, especially in a politically sensitive area like Medicare Advantage, it can create a perception of risk, regardless of the company's defensive posture. However, it's not all defense. On the operational front, you had Optum Rx, their pharmacy benefit arm, make a notable adjustment back in July. They eliminated reauthorization requirements for over 60 chronic care drugs. That move was actually heralded by patient advocates as a long overdue common sense step. And this isn't just about reducing patient friction, though that's important. It's probably a strategic play for Optum too, enhancing patient loyalty, maybe capturing more data insights. It reinforces its role beyond just, processing claims.
That's a clever move. Streamline the patient experience, gain some goodwill. Okay, we also saw UnitedHealth secure nearly $1.7 billion in government contract payments for the quarter. That reinforces federal revenues as a stabilizing factor.
Exactly, a key stabilizer.
Then there were some leadership changes, the annual shareholder meeting. There are also this brief, unsolicited mini-tender offer from a company called Tutanota for less than 1% of shares. The company told shareholders to disregard it. Does that mini-tender offer signify anything, or is it just market noise?
Given it was unsolicited, and for such a tiny percentage of shares, it's largely considered market noise, almost certainly just an opportunistic play to try and buy shares below market value. That's why the company said ignore it. The bigger story there is definitely the continued flow of those government contracts. They truly act as a stabilizing counterweight to some of the other volatility we've been discussing.
Okay, after that whirlwind of recent market activity, let's try and ground ourselves in the concrete numbers. The Q2 2025 financials, they should offer a clearer picture of UnitedHealth's operational health. At first glance, those revenue figures look pretty robust, don't they?
Absolutely. Yeah, UnitedHealth reported Q2 2025 revenue of $111.6 billion. That's a robust 13% increase from the prior year. And this was primarily driven by a 14% rise in premium revenue and strong growth in Optum's volumes and pricing. So on the surface, it definitely paints a picture of healthy top-line expansion.
Strong revenue, always good to see. However, if we dig a bit deeper, earnings from operations dropped 35%, down to $5.15 billion, and net earnings for Q2 fell to $3.57 billion. What does this divergence, this gap, tell us about the company's underlying health, especially when revenue is still growing like that?
Right. This is a critical point. It's something analysts are scrutinizing really closely. Despite the higher revenue, that decline in earnings highlights significant margin compression. The medical care ratio, the MCR, it increased to 89.4% in Q2 2025. That's up from 85.1% in Q2 2024. An MCR of 89.4%. Well, it isn't just about costs outpacing revenue. It directly impacts their ability to maintain profitability. It could even signal future challenges in negotiating provider rates or navigating regulatory premium caps. It clearly indicates cost growth outpaced those top-line gains. And it's largely attributable to those elevated medical costs and the Medicare Advantage funding pressures we mentioned earlier.
So that squeeze on profitability is, pretty profound. From our sources, does this indicate UnitedHealth is maybe sacrificing short-term margins for long-term market share? Or is more of a reactive challenge to these unforeseen cost spikes?
Our sources suggest it's probably more of a reactive challenge. Higher than expected medical utilization, and in some cases, regulatory changes impacting funding for certain programs. However, if we connect this to the bigger picture, year-to-date net earnings for the first half of 2025 actually totaled $10.05 billion. So that shows a rebound despite that really tough operating quarter. The company also reaffirmed its adjusted full-year 2025 EPS guidance, though they did note the recent Amedisys acquisition will be dilutive in the near term. Integration costs, financing costs. So it suggests they anticipate a recovery, but yeah, not without some bumps along the way.
Okay. And what about their overall financial strength? Their balance sheet, liquidity, their ability to sort of weather these cost pressures?
UnitedHealth Group maintains a remarkably strong financial position, really solid. They did issue $3 billion in senior notes back in June 2025. But their total liquidity stood at a massive $77.3 billion in cash and investments as of June 30th, 2025. Yeah, that kind of war chest provides a significant cushion. Operating cash flow for the first 6 months of 2025 was also robust at $12.6 billion.
And they even raised their dividend amidst these challenges. That seems like a powerful signal.
Indeed it is. The annual dividend rate was recently raised to $8.84 per share. That move really underscores strong free cash generation despite those short-term margin pressures. It suggests management's pretty confident in the company's long-term ability to generate cash flow.
Right. So despite these, let's call them financial complexities and operational headwinds, fundamentally, UnitedHealth Group remains an industry powerhouse. What gives them that durable competitive edge?
It really comes down to their sheer scale and that dual engine strategy they have. It's the largest managed care company in the U.S. by revenue, by lives covered. Its reach in both insurance through UnitedHealthcare and health services through Optum, that's a significant competitive advantage. That scale lets them negotiate better rates, invest heavily in technology, and frankly, withstand market shocks more effectively than smaller players can.
And Optum. It really seems to be more than just a division, doesn't it? It feels like a strategic evolution for the company.
It absolutely is. Optum isn't merely diversification. You can argue it's UnitedHealth's strategic evolution beyond being just a traditional insurer. It's transforming them into an integrated healthcare services powerhouse. This segment, pharmacy services, care delivery, technology, it's crucial. It helps balance risk from policy changes or those medical cost spikes that might affect their core insurance operations more directly. This shift aims to capture value at pretty much every point of care. That could potentially insulate them from policy changes that might hit pure insurance models harder. And their market share remains strong, too. About 78% of members are in 4-star or higher Medicare Advantage plans. That speaks to their quality and reach.
Okay. For those keeping a close eye on the stock price, let's turn to the technical picture. What has UnitedHealth stock been doing recently on the charts?
Well, over the past 4 weeks, leading up to around September 13th, 2025, UnitedHealth traded in a range, roughly $482 to $512. It's been consolidating, basically, after recovering from those late August lows. So after that big jump from the Berkshire Hathaway news, yeah, it's been moving somewhat sideways.
And what does that sideways movement imply for, say, technical traders? What are they seeing there?
It suggests a period of, well, digestion and maybe some uncertainty. Key support is observed near $485. That's a level that was tested previously, right after the Q2 earnings release. On the upside, notable resistance seems to be around $515, $520. A clear breakout above that level would likely be seen as a bullish signal, indicating some fresh momentum.
And what are the other technical indicators telling us? Anything significant there?
Well, the 50-day moving average is hovering around $495, with the 200-day near $488. The stock is currently testing the upper band of this zone, which implies maybe a neutral to bullish intermediate trend. Momentum indicators like the RSI, they've hovered in the 48-56 range. That suggests neither really overbought nor oversold conditions. And the MASI indicator has flattened out, which again signals that consolidation is really the dominant theme right now.
Okay. And general market sentiment around UnitedHealth. Are analysts leaning one way or another, or is it still pretty mixed?
Sentiment is quite neutral, actually. It's a bit of a mixed bag in the commentary. Analysts are understandably cautious. Several are maintaining neutral ratings pending the full integration of Amedisys and just getting more clarity on those cost controls we talked about. Most recent analyst target prices seem to hover between $520 and $540. That suggests only modest upside from current levels. And insider transactions, which people often watch, they've been pretty minor. No significant buying or selling from top executives recently.
Right. It sounds like investors won't be bored for the next few months then. Several critical data points seem to be on the immediate horizon. What should we really be watching for with UnitedHealth Group in the short term?
Okay, short term, the big one is Q3 2025 earnings. That's anticipated around late October. Crucial. The focus will be squarely on the company's ability to, 1, control medical cost inflation, and 2, execute on their guidance. Can they hit their numbers? Beyond that, we have a major U.S. ETF rebalancing coming up on October 18th. And then the highly anticipated CMS Medicare Advantage 2026 star ratings on November 1st. Both of those could definitely drive some volatility. Investors will also be looking for updates on the Amedisys integration costs and any hints about potential medical cost reduction synergies coming from that deal.
Okay, so those are the immediate kind of market-moving events. But what about the bigger picture? Long-term trends or maybe more speculative catalysts that could shape UnitedHealth's future down the road?
Well, there's persistent speculation surrounding UnitedHealth pursuing additional Optum Health tech partnerships, or maybe even strategic bolt-on acquisitions to boost that vertical integration even further. There's also quite a bit of industry chatter about major initiatives leveraging AI, for claims processing, patient care. That could certainly drive a powerful new growth narrative if they get it right. Rumors also circulate maybe potential divestiture of non-core assets to focus on the high-growth segments, and even the possibility, though this is more speculative, of a special dividend or an expanded share buyback program.
Okay, and every opportunity comes with risks. What are the main risks that could potentially impact UnitedHealth Group's trajectory? What should investors be wary of?
The primary stock-specific risk, I'd say, remains that sustained elevation in the medical cost ratio, currently at 89.4%. If that stays high, it can continue to compress margins. That's number one. The Amedisys acquisition also carries significant integration risk. There's potential for cost overruns, maybe lower than expected savings. Integrating big companies is always tricky. Beyond that, you've got the broader market and sector risks that are always present. Potential adverse changes to Medicare or Medicaid rules, that's a perennial concern. The impact of PBM transparency laws that could force greater disclosure on drug pricing and rebates, potentially squeezing OptumRx's margins. And then, of course, macroeconomic factors like recession risk or labor cost inflation. Those affect everyone.
Right. So after exploring all of this, from recent market moves, the financials, future risks, let's get to the big question. Is UnitedHealth Group a good time to buy now? What's the overall assessment of its investment potential today?
Okay, so boiling it all down, our analysis gives UnitedHealth Group an overall rating of, let's say, 6.5 out of 10. Look, the company remains an industry leader. It has formidable scale, that crucial diversification through Optum, and really robust cash generation. Those are powerful fundamental strengths, no doubt about it.
Yeah, those strong fundamentals are clearly facing some pretty significant headwinds right now.
Yeah.
It makes for a very nuanced picture, doesn't it?
Precisely. Yeah, nuance is the right word. Those elevated medical costs and the near-term earnings dilution from the Amedisys acquisition, they reduce visibility into margin recovery for the next few quarters at least. The stock also appears, arguably, fairly valued on current multiples. Consensus analyst targets only suggest modest upside from here, so this doesn't exactly look like a company trading at a deep discount.
Okay, so for you, our listener, thinking about this, What does this nuanced assessment actually mean for your investment strategy? Is this the buy, a hold, or maybe a wait-and-see situation?
Well, I think this suggests UnitedHealth Group is probably better suited for a long-term investment horizon. Its durable competitive position, that recurring premium revenue, and the powerful tailwinds of long-term healthcare demand, those things support a patient, strategic investment approach, if you've got time. However, it's likely not ideal for short-term trading right now in the near term, given the earnings dilution risk, the margin uncertainty, and frankly, a lack of immediate technical momentum. So maybe think of it as a potential foundational holding, but probably not a quick trade for the next few months.
That's incredibly insightful. Yeah, it really puts the complexities and the opportunities into perspective, and especially highlighting that crucial distinction between a long-term play and maybe a short-term gamble. So as we wrap up here, UnitedHealth Group presents this really fascinating case, doesn't it? An industry leader facing both strong tailwinds and significant operational challenges. The interplay of institutional interest, strategic acquisitions like Amedisy, the push for operational efficiency, all set against this backdrop of rising medical costs. It makes for a deeply nuanced picture. Ultimately, UnitedHealth's trajectory won't just define its own future, but perhaps it could serve as a kind of bellwether for how the entire healthcare industry evolves, caught between technological innovation and these relentless cost pressures. So as you consider your next move, maybe ponder this. Is this the blueprint for resilient growth in modern healthcare? Or is this a company at a critical inflection point where scale alone might not be enough to win the day? Something to think about. Thank you so much for joining us on Investing Talk Podcast.
We hope this exploration has given you a clear understanding of UnitedHealth Group. Until next time, stay informed and make smart choices.